Hello, everyone. This is Jim Martens, and welcome to today's edition of Elliott Wave Traders Classroom. I'm going to show you a very basic concept today and some examples of that basic concept in action to show how just a simple market movement can have so much or provide so much information about what's to come next. As usual, when I talk about the basics, I start with the Elliott Wave Principle by Frost and Prechter. It's always available to you online if you don't have a physical copy of your own, and you should keep it nearby. As someone who has been using the Wave Principle since the mid-'80s and since 1989 professionally, it's my one and only method of analyzing financial markets, and that's all financial markets. Doesn't matter. I specialize currently in commodities, but in the past, and that's where I started. But I've followed Forex, interest rates, fixed income around the world, equity markets around the world. And I still use, after all these years and all that experience, still use the Wave Principle as basically about 100% of my methodology. So without further ado, let's move into what is most simple about the Wave Principle, most telling, and that is just the basic pattern. 5 wave movements unfold in the direction of the trend at one larger degree. So if you see what looks like a significant bottom, just imagine a market's been declining for a fairly lengthy period of time, and then all of a sudden it displays an impulse rally sequence like in figure 1-1 in 5 waves, and it meets the rules. Wave 2 retraces less than 100% of wave 1. It can retrace up to 100% of wave 1, but no more. I say that because I've seen a couple examples lately that are very close to 100%, surprisingly close. Wave 3 cannot be the shortest of waves 1, 3, and 5. Now, it doesn't have to be the longest wave. It often does represent the extended wave, but the rule is it just can't be the shortest wave. So there are times, for example, that wave 3 will travel a shorter distance than wave 1. But if that's the case and the count is correct, then wave 5 is limited to the distance traveled in wave 3. It can tie wave 3 in terms of distance, but it cannot exceed it. Now, normally the third wave is the extended wave, and wave 5 will tend towards equality with wave 1. And then wave 4. Ideally, it should end above the end of wave 1 to avoid overlap. And usually there's no question about this rule being satisfied because the third wave is usually extended. So the fourth wave has no business near the end of wave 1. And then, of course, we expect wave 5 to exceed the end of wave 3, but that's not a rule. We have waves we call truncated or failed fifth waves. Okay, and even if off the low you were to spot this rally and it wasn't the start of a fresh trend, so if the market had been declining and now all of a sudden on some time frame you see a 5-wave rally, if it doesn't mark the start of a new trend in the market, at a minimum it's wave A of an ABC correction. So there would be more to go to the upside because after a 5-wave advance, the market would set back in 3 waves to correct that advance. And if this were a correction instead of 1, 2, it would be A, B, and we'd expect a second similar 5-wave rally like wave A to unfold in the wave C position. So even if you're kind of lost bigger picture in the count, sometimes spotting a 5-wave movement from a market extreme gives you a sense, at least in the short term, of where the market's headed. First, a correction of that 5-wave movement, followed by a second similar 5-wave movement. Okay, so again, this is the very basics of the wave principle. We're not going into individual patterns, wave 2 being a zigzag or a triple zigzag or a combination, wave 4 maybe a triangle. And I mentioned the relationships in wave 3 being extended and relationships between 5 and 1, etc. Not going into any of that, just the basic 5-wave pattern, which is corrected in 3 waves, and taking that to 3 markets that were interesting to me just this morning, sort of out of the blue. So I changed what I was planning to talk about because I thought this is just that much more important. So without further ado, let's move from the textbook, which I remind you is available to you. And if you don't like the online version, I usually keep my hard copy right on the corner of my desk. And yes, after some 40 years, I still refer to the book more often than you might think. So let's jump down to a chart, and we're going to first take a look at corn. You'll first notice that on the daily chart on the left, that corn has been falling for quite a while. From late February, the market declined from near 480 a bushel down to 416. Percentage-wise, quite the decline. I think it followed a corrective path, and it's not my purpose to go into the labeling of the proposed double zigzag. It's just enough to say that that looks like a corrective retreat. Suddenly, earlier this week, corn turned around, and then on Wednesday, surged. And then even today in early trade, continued that surge. And that alone might grab someone's attention if they were to look at the chart. But as a user of the wave principle, we say, yes, that's an impressive rally. I wonder what the structure of that rally might be. And you can see it on the 15-minute chart on the right. From that 416.5 low, I counted a possible 5-wave rally. And if it's true that that is a 5-wave rally, just what we spoke about from the Elliott Wave Principle book kicks in here. You say, well, what should happen next? What should corn do? Well, that 416.5 is what could be a significant low given the decline into it. I don't see the rally as the end of a corrective move to the upside. Given that it's in 5 waves, it's likely the first wave of something larger to the upside. It's either wave 1, as it's labeled, or wave A of what would be an ABC advance, ultimately. Well, in both those cases, the rally should be corrected. We know that correction should unfold in 3 waves, A, B, C. It should end no lower than the origin of the rally being corrected. That's 416.5. It's more likely to end closer to a Fibonacci retracement target, and you can see those marked at 432.5 roughly. Wave 2 will retrace, or B, I should say, 2 or B, will retrace 38.2% of the rally, and a bit lower at 426.25. A correction would retrace 61.8% of the rally from 416.5. So we have a couple of objectives. Now we're going to follow this setback and follow its structure. If it's in 3 waves and it nears one of these objectives, but structure is more important, then we're going to consider that setback a correction within an advance that's occurring at one larger degree. And we'll look for a second impulse rally in either wave 3 or in wave C. We could take it further and say, well, if it's wave 3, it's probably going to travel 1.618 times the distance traveled in wave 1. If it's wave C, closer to equality. So the extent of the subsequent rally will help us determine if the wave 1 label is correct or should it be a wave A. But either way, this impulse rally, even on this 15-minute chart, tells us that this rally on the daily chart from 416.5 is incomplete. There's more to go. And that is valuable information.